right, everybody. So, coming out of the keynote and looking at what Chris and Chris have come up with for running Flame with GPUs and everything, I'm sure everybody's excited to take what's coming out of this talk, immediately run to the room, and just start printing money, right? Everybody excited about that? Yeah, that's not going to happen. So I just want everybody to know that I am not a certified expert or anything like that. There's always a risk of losing money when you invest in the stock market. So if you're going to put your own money into this, do that at your own risk. But that being said, like, why even give this talk then if this isn't like a sure thing? And really, it's just an interesting problem. There's a lot of data available. It's mentally stimulating. Like, it just keeps my attention, and you can always keep going with it. And there's a lot of fun considerations here, especially when doing machine learning with time series data. In addition to that, last fall, I just wrapped up my master's in computer science and machine learning, and we did a class on machine learning for trading, and all of the coursework for that was in Python. And now that I feel like I've got all kinds of free time now, I was like, we can do this in Elixir. Like, we have NX, Axon, we have all the tools that we need. So what we're going to do is we are going to talk about how do we frame this problem of doing machine learning for stock trading as a machine learning problem. And we're going to start by briefly discussing how do day traders, how do people that work at hedge funds pick their positions that they're going to make in the market based upon based upon the indexes that they are going to trade. Then we're going to talk about how do we take that knowledge, get that into a model or policy. Then in order to do that, you have to have an algorithm to be able to train. So we're going to talk about how do you pick that, and we're also going to talk a little bit about how you evaluate your results. So let's get started on how to pick your positions, and specifically we're going to use what is called technical analysis. Technical analysis is like what Medallion and Jim Simons does. The theory here is that the price and volume information for the stock encode everything that you need to know about the market in order to be able to make a decision on whether or not to buy that stock. And if you take a little bit of time to think about that, like, if you like cars, every time Ford announces a new model of the Mustang, their stock immediately goes up in value. So yes, you could try to encode like sources from like the news into your model as well, but the market is going to react so fast to that the price and volume information is what you need. And basically what you're going to do is you're going to take that price and volume information and you're going to compute a set of indicators. And these are just formulas that you can use on any kind of like time series data in order to be able to determine like the strength of a trend, like whether a stock is nosediving or is like hockey sticking like upwards, and you'd be crazy like not to buy in. So what we're going to do is we're going to take a handful of these indicators and we're going to use that to be able to say like, hey, if multiple of these indicators, if many of these indicators are indicating that the price is going to go up, then we want to buy and hold that stock. If it's indicating that it's going to go down, we want to exit that position, or we want to short it, which is you're going to bet against it. You're going to sell stocks that you don't own from your broker, and you eventually have to buy them back to exit that position. But you end up selling, for $10 a share. You buy back out for $5 a share. You made $5 a share. That's what shorting is. And I could talk about this for a long time, probably until my dying breath. But I will say that Investopedia is your friend. Like, if you're interested in this, definitely go look at Investopedia, because you will get a lot of this like nuanced information, and there will be a lot of information on strategies and different indicators to choose. So now that we know that we want to take these indicators and encode that into our model or policy, how do we do that? Well, we do that by taking the data. We're going to get the price and volume information from whatever data source that you're using. In the livebook, I've got another link for that at the end, but you'll see that I'm using Yahoo Finance's data set, and that's specifically because it's a bad data set. It gives you daily information, and with these kind of techniques, you really want like the data to be at a second resolution. Like, you have to make decisions very, very quickly in order to make money in this kind of case, because otherwise you can, miss it by even just seconds and lose a ton of money. So we're going to get this data from our data set. We're going to compute the values of the indicators that we chose for our strategy, and then we're going to kind of do like what we would do in setting up our training and testing data set. We're going to split this up. Since it's time series data, you want to split at a specific date rather than take like a random sample like you would like if you were trying to work with like the wine data set or something like that. And then what we're going to do is we're going to supply this as input. As output, we want to know whether we want to buy and hold or if we want to sell and go short. So now that we know that that's kind of what we want to do, we need to pick an algorithm in order to do that. And if you think about it, if you look in Bumblebee, a lot of the models and transformer models in there work with either like image classification type tasks or natural language tasks. Now, for an image, you're going to be looking at like a frame at a point in time. So we don't want to emulate one of those techniques. But if you think about it, natural language is like a time series of words. And there is some evidence to suggest that natural language techniques can work with time series data. And thankfully, on Axon's documentation, there is a guide for a natural language task that uses a type of layer called LSTM, and this stands for long short-term memory. And I don't want you to panic. I know that I've got like a diagram of math up here on the screen, but we're going to break this down. It's really not that bad. Basically, what's happening here is you have your input at a time step. And what you're going to do is your data, you're going to chunk it up. So take like a rolling window of like 10 days worth of data, for example, or 10 time periods worth of data if you're working with a finer resolution, and you're going to supply that as input. Then what we also have a hidden state and a cell memory. The hidden state is like the parameters that Chris was talking about in the keynote. This is the part that you're trying to learn and that you're trying to train, because it will ultimately determine how much of the input is important and be able to specify like how important that is. But where this differs from like linear layers in Axon is that we also have an additional input at each layer called cell memory or cell state. And this is going to tell us how much of the past we need to pay attention to in order to make a decision about a future, in order to identify, like, is this trend going up or down? So that's where we have these 3 gates. This first gate is saying, hey, for this input, tell me how much of the past that I need to look at and how important the past is in being able to make this decision. Next, we have our input gate, which is we're going to now figure out for our current state, how important is this current state. The output gate here, in natural language, we're predicting usually the next character or the next token in the string that we're going to use. So like if you're doing like translation, this would give you like an output of, you know, the next character or the next word in the translation. But in this case, our output is going to be whether or not we want to buy and hold or sell and go short. So hopefully that was gentle. Like yes, there is a lot of math up here, but it's really not that bad. Like once you break it down and understand what is happening here. So in doing this, we definitely prefer simple solutions in machine learning. Like you don't want to ask ChatGPT how many R's there are in strawberry because it will tell you 2. And you can easily just like split the string up into characters and count all of the ones that are R's. Like that's an overkill solution. So we want to do something relatively simple. So we're going to naively just follow this guide. We're going to compute these indicators using Explorer. We're going to have all of our batches and everything. And we go through all of this and it didn't work. So that was fun. But you know what, like, it's a learning experience, but we're only like 10 minutes into this talk, so this isn't the end. What I saw in doing this was that in training, the model reported like a 30% gain over like a 2-year time period, which is absolutely ridiculous. But you can't look at that like that. You're basically having your model memorize the past. So it has perfect information about that. Once you start evaluating that on a time period where it has not seen that data before, it doesn't make any money. In fact, at first, before I fine-tuned it, it was losing money. And then I was able to get it to a point where it didn't lose money, but it didn't make any either. So what we ended up doing was we framed the problem wrong. Rather than being able to optimize for the position that we want to hold, what we need to do is we need to optimize the rewards that we receive, the gain that we get here. And what we're going to do is we're going to look at another technique. But before I do that, like in looking at this next technique, in implementing the algorithm, I asked ChatGPT, like, hey, can you give me a boost? Can you give me an implementation of this algorithm using Axon and NX? And it gave me some code back, and I was like, okay, it imported all of the modules. So I had no idea where the documentation came from or where to even look. So I said, hey, don't import. And it just put Axon dot in front of everything. So, you know, if you play a stupid game, you're going to win a stupid prize. And that's what I won. So then I started looking at the Axon documentation. And I was like, hey, like, none of these functions are here. But, you know, GPT 3.5 was trained, you know, with data as of like a couple of years ago. So let me look at an older version of the documentation. I go back in time, it's still not there. So then I just asked, I was like, hey, explain yourself. Where did you get the information in order to say that like this was the functions that you need to use? And it literally said verbatim, Axon and NX are fictitious packages. They do not exist. And I was like, all of our jobs are safe. You know, like we have nothing to worry about. Like AI doesn't know anything. It's literally just like trying to make you happy. But with this next technique, you know, LLMs are trained and fine-tuned using what is called reinforcement learning with human feedback, or RLHF. If you go and read a white paper about like GPT-2 or GPT-3, you'll see a reference to this. And what this does is the model will produce an output, and then the user or whoever is training it will say like, yes, this is good, or no, this is bad, and it will kind of learn what is good and what is bad. So let's try reinforcement learning. This is a better technique here, because in reinforcement learning, what we are solving are called Markov decision processes, or MDPs. And this is a very heavy math-loaded term, but the Markovian property states that all of the data that you need in order to make a decision is encoded in the current state. So if we think back a couple of slides to where we talked about technical analysis has a very similar kind of feeling to it, right? Like all of the information that you need is here in the state, in the price and volume information. So what we're going to do with an MDP is we're going to iterate through time, and collect a collection of experiences. And each experience is going to be the current state, the action that you want to do, whether or not you want to go long or short, the reward that you get, or technically the discounted future reward that you can expect to receive for taking that action at that state, and then you're going to be given a next state. And in order to do this, like, we're going to learn a policy in order to tell the agent how to operate in the environment. So this works very well in like the stock trading situation, because it will consistently apply your strategy based upon the data of the indicators. So what we end up doing, we can treat this as a time series, because each experience is just like a time step in your data set. And I've got this picture up here. You may think like we haven't talked anything about like navigation or anything like that. But if you go online and look on like YouTube for like StatsQuest or something like that, which is an excellent resource for learning more about this, a lot of the introductory material on reinforcement learning is kind of like navigating, the agent navigating through like a grid world. And this is usually because reinforcement learning is used a lot in robotics as well, in order to be able to learn how to navigate through a path. So we've talked about a couple of things here, or a couple of pieces. We've talked about an agent acting based on a policy, and an agent acts within an environment. And what's going to happen here is that we'll see later on that these are going to be two separate pieces of code. The agent is going to learn a policy and act in accordance to that policy in a very strict way, and it's going to optimize doing the best action that will maximize our rewards at the end. Now, the agent doesn't necessarily know anything about the environment. The agent is told, hey, you're at state 1, 2, 3. You have actions 0 through 4 or whatever. Like, tell me what you want to do. And the agent starts out knowing nothing. Eventually, over time, it learns how to operate because it knows the rewards that it receives from the environment. So the agent learns the policy and acts in accordance to that policy, and the environment is just the external factors that the agent operates within. And we're going to use that as our like stock market kind of environment. And we've talked a little bit about a policy, but I want to explain this a little bit more. And really what we have here is that our policy will tell us at each state, if I take any of these actions, the value in this table is going to be our expected future reward. So if I am in state 0 and I take action 1, this is what I can expect to receive later on at the end because I took this action in this state. And this is a really good picture of this because this is just like a two-dimensional array, right? Like you have states on one axis, actions on another axis. Like this is a very simple data structure for us to work in. And we learn a policy by doing a bunch of math. And just like last time, we're going to break this down. It's really not that bad. I know that there's a lot of Greek in here, and you're going to be like, Sam, like what? Like it's too early for this. So let's break this down. We've got, at the beginning of this equation, we have Q of SA. Now in math, capital letters represent matrices, and that's going to be our policy that we just discussed. That's going to be a two-dimensional array. And then we have S and A here. This is going to be the index for our state and the index for our actions at time t. Now, this is where things get weird because you have an arrow and then you have Q of SA again. So what this means is that the arrow, since it's pointing back at QSA, we're going to make an update. This isn't going to be an equality. We're going to end up making an update to the value that we have in the table. And then we have Q of SA here again. But like this is the mathematical way that you see recursion, which we're all very familiar with as Elixir developers. So go ahead and relax knowing like, hey, like this is recursion. I understand this. I know what this is. Like I've seen it. It's like at the end of Jurassic Park when she's like, this is Unix. I know this. Like this is recursion. You know this. So now what we're going to do is we're going to add to that current expectation of the reward. We're going to learn something. This is going to be how much we change by. And what we have here is alpha. Also in math, like Greek letters, other than like delta, which means change, they're usually a constant. So like what Chris talked about in the keynote where he was, creating the grid of different learning rates to be able to test with, that is alpha in this case. And what that's going to do is that's going to ensure that we learn a little bit. So then that way, as you converge to a solution, like it's a smooth convergence. Because if you every time just like wipe out your current memory and just go with, okay, this is what I saw last time, so this is what I expect to see next time, it's going to be a very chaotic learning process and the model won't actually converge to a solution. So that's where alpha comes in. We want to learn a little bit at a time. And what we're going to do is we're going to take a little bit of the next reward and then we're going to take the best next action at the next state. That's what this max over A means. This is saying, hey, for the next state, look at that entire row in the table, pick the best value, what is the index of that action. That's the action that I want to perform. And then we have gamma here, which is a discount factor. This is another constant. And what we're saying here is that, if I take an action at this time step and I make $1, at the end, I don't necessarily have $1. Like the price of the stock market will go up and go down. So there will be some fluctuation here. So this discount factor, which applies to all reinforcement learning problems, is saying that if I get $1 here, I can expect to make, some fraction of that at the end because I took this best action in this state. And then what we're going to do at the end is we're going to subtract the current value of the current state. So then that way we don't double count here. So this gives us a much smoother convergence. in order to do this. And now that we've talked about like how the agent learns its policy, we also have to define an environment. And what we're going to do is create a stock market simulator. And what that's going to do is it's going to simulate trades. It's going to simulate buying. It's going to simulate selling. And what you're going to do is you're going to create a data frame, which is effectively like a spreadsheet for your portfolio. And you're going to keep track of how much cash you have on hand, which stocks you are trading and their prices, and then you're going to keep track of how much of that you hold. So then that way you can compute the delta in cash for every time period in here, and that's what this formula here is doing. You know, the change in cash is my current cash minus the fee that I pay for trading, whatever your broker charges. Like if it's like Robinhood or E-Trade or something like that, it's usually like $9.95. So that is also a constant. But then we have how much we're going to hold of that stock times its price minus an impact, because every time that you make a trade in the stock market, the price moves against you. Like as you buy an index, it will drive the price up. As you sell, it will drive the price down. So there's always going to be some impact there. And you can use this in training as a hyperparameter in order to be able to say like, hey, like you're trading too often, let me increase the impact here. So then that way you pick better trades. And then what we're going to do throughout our portfolios, we're going to basically take the cumulative sum, which is basically the sum of all of the rows of the cash up until that point in time, and we keep like a running total of that, because we're going to use that in our value calculation, which ultimately we're going to end up using as our rewards. So before we look at the results, we've talked a lot here and we haven't talked about any downsides. So I definitely want to cover this real quick, because if you look back at the equation, or at the Bellman equation, we are performing the best action at that state. So when you first start training your policy, your agent doesn't know anything. So if you happen to take a path through that environment where it makes money one time, if you always take the best action, you will only ever improve that state action path through the policy, which is not what you want. Like that, yes, eventually like you want to exploit the policy, but you don't actually learn anything. And in reinforcement learning, this problem is called exploration versus exploitation. You know, so in the beginning, you don't know anything, so you have to mess around, learn, and find out. So the technique that we use for this is called epsilon decay. Yes, that's another Greek letter, but it's another constant. And what that means is that you're going to start with usually 1 or 100%. And at the beginning, rather than taking the best action, you're going to take a random action. So you're going to sample a value between 0 and 1, and you're going to compare that to epsilon. Then if that value is less than epsilon, you're going to perform a random action. Otherwise, you're going to perform the best action that you know of at that time. And as you train, we're going to do multiple episodes of these experiences. So once we get to the end, we'll start over and go through it again. You have to make epsilon smaller by an epsilon decay amount, which is usually like multiplying whatever value you have for epsilon by like 0.999 or something like that. So then it will gradually reduce. And then over time, as you learn and explore your policy, you'll start to exploit your policy and confirm your findings and be able to find the best path through that. So that's another important consideration to keep in mind. But another consideration is that in our state action space, our actions are discrete in that we can go long or we can go short, but our states are not continuous values. They are continuous values, they're not discrete values. So if you try to index the array at like the indicator value of like 20.4, like what does that mean? So what we're going to do here is we're going to take our data, and for each of our indicators, we're going to compute a range over those indicators, and we're going to break that up into 10 equal segments. So then that way we can convert the indicator values into state. And then what you can do is that, the first indicator will represent like the ones place in a number. Your second indicator can represent the tens place, and the third the hundreds place. But like as you think about that, like your state action space increases at an exponential rate when you do this, because if you use two indicators, you only have 100 states, but introducing a third indicator makes it 1,000 states, and a fourth 10,000 states. So as you add more indicators that you're going to train with, you have to have a larger data set. You have to look at a longer time period in order to be able to effectively, explore the environment. Now, once you get to a point where there's a very large state action space, you can switch to an algorithm called DQN, which we've been looking at. Is called Q learning, and the Q stands for quality. It's the quality of the state action pair. DQN is Q learning with a neural network crammed into it. So basically, you're supplying the raw continuous state values as input into this model that the agent learns, and then you still receive, the same output that we're expecting. So that makes it a little bit easier. Now, how do we translate this into code? It's gen servers all the way down. And it makes sense because we've used words like state and agent. And as we need to keep track of epsilon in our training process, we can make that part of our state. The policy is part of our state. And the agent is going to keep track of that policy and that epsilon, whereas the environment is going to keep track of where it is at in time in order to be able to give us our states and our rewards. So it's gen servers all the way down, which is also something that we're very, very familiar with. So in looking at the results, on the left, I have kind of like the training to see how much it makes, and it, didn't do great, but I needed to evaluate like over a 2-year time period in order to have enough data to learn with. But then on the right, this is where we evaluate for like a year where this policy has not seen this data yet. And, at some points in here, it makes almost 10%, but you can see that it goes over time, it goes down. And if you evaluate this over 2 years, it actually ends up losing money, which brings up my next point, that models rot over time. You have to continuously update them and retrain them. But the good thing is that since we built all of this in gen servers, we have that state, we have that algorithm. As new data comes in, we can perform another training episode and be able to get that data into our policy. So that's something that's really powerful that we get for Elixir. So I know that this talk is running a little bit long, but we talked about how do we pick these trades. It's a lot of math. Designing machine learning agents is hard, as we saw at the beginning, because it didn't work, which is comforting to know that you can't just like slap AI on a problem and call it solved. And you also need a lot of money to make this work. Like in my simulation, I was looking at JP Morgan as a stock, and I was going long and short by 100 shares at a time, which at that point in time, you needed $250,000 in cash to be able to do that. So get a rich dad. Other than that, like Why did we go into this? Like, gen servers are powerful. It makes all of this easy. We can always like continue learning and continue working on this. And we know that this has to be like very reliable and have a high uptime for this specific problem, because a missed trade window is a disaster. You're going to immediately start losing money, and you're just going to try to like put a tourniquet on it and stop the bleeding. So we can do better. So these are the resources, and the slides are available online, like at this link as well. So that way you can look into this a little bit further. But like, since reinforcement learning is looking at time series here, you can also try to frame other time series problems in this way. This was just like an easy and interesting example to like grab your attention in order to be able to now investigate, like, okay, how do I solve like the cart pull problem and being able to keep the cart pull standing up like automatically? Or how do I do the hill climb in order to make sure that the underpowered car can make it up the hill? Or even with a lunar lander, like, how do I land on the moon without like crashing and dying and leaving people on the moon? So there's a lot that you can do here, but I'm going to stop talking. I don't know if we have time to take questions. We don't have time to take questions. I'm sorry for that. But I literally just took like 16 weeks worth of course material and talked about it in half an hour. So please find me at the conference if you have any questions. I would love to talk to you about this. I could, like I said earlier, I could talk until my dying breath about this. So thank you very much.